Hello, welcome back to Harvesting Income. Today I'm going to talk about this interesting fund named SDTY, which is the YieldMax S&P 500 Zero DTE Covered Call Strategy ETF. That's a mouthful. It's basically a zero DTE covered call ETF similar to the Roundhill's XDTE. This fund is fairly new, launched in February this year. So it's relatively new with a smaller history and yeah, it remains to be seen how the fund is performing. But let me first give you an overview about SDTY and then I'll jump into the main topic of the video. And can this fund beat XDTE? So, to answer that question, we need to have a comparison of these two funds, which I'm going to do at the end of the video. So, please stay tuned. First, I'll go through the SDTY to understand how this works. So you can see the name, it's basically the YieldMax S&P 500 zero DTE covered call strategy, and it's an actively managed fund and primarily seeks income first, and then secondarily it would be like capital appreciation. How do they do it? So I went through the prospectus, and prospectus clearly tells two key facts, which I will quickly show you. Um, the main objective is current income, and the fund's secondary objective is capital appreciation. But when we look at the strategy, it's almost the same as XDTE. I don't see much of a difference. They use the synthetic covered call strategy to generate income on a weekly basis and also provide exposure to the S&P 500. So when I looked at the details of how they get the exposure to S&P 500, it clearly states that the fund is actually purchasing deep in the money calls. You can see the points highlighted here. The fund purchases deep in the money calls and on the index S&P 500. And why deep in the money calls? Because deep in the money calls are those where the index level is above the strike price of the option, and due to that, the option price moves exactly in tandem with the index. Like, so here they say that you know providing the fund with price exposure to the index returns, similar to owing the index securities directly. So just to put it in a simple language, they're basically saying that the synthetic long exposure, the synthetic long call option, is going to move in tandem with the index. So let's say the index moves up 1%. This in the money, deep in the money call is also going to move almost like 1%. It may not be exact, but it will be more or less in that range. So that's how it's going to work. So when that happens, they are able to replicate the price of the index. So it is almost like you have the index in your portfolio. It's almost like owning the index, but instead of owning the index, they are owning the option, which is cheaper, and the same amount of index can be held using the deep in the money calls, and it's basically called a leap option strategy, which is beyond the scope of this video, but it's basically long-term options they hold it, which is like similar to holding the underlying asset. So that's the basic concept. And so basically what happens is here I can brief you on the call option strategy. A synthetic call basically serves as synthetic call basically is the long position. So basically fund synthetic call strategy involves combination of selling and purchasing options on the index. So now that they have the long index option in their portfolio, they can sell out of the money calls like every week to generate that regular income or even every day. Like, so here they say that the fund sells out of the money call options on the index or index ETFs with zero dates to expiration, meaning these options expire at the end of the same day they are sold. So it clearly mentions black and white that they are selling options every day and these options expire at the end of the day. So basically they are selling options on every trading session or day, and those options are expiring at the end of the day. So let's say somewhere in the morning they sell the option and they buy, and at the end of the day the option expires. So whatever premium they received is being kept by the fund, like so that is like the profit earned, like, or it could be a loss sometimes. So that's how the whole strategy works. That's how it's being executed. So that part is pretty clear. Let me go back to the details of the fund. Okay, the fund has been in existence for about 3 months. Not much of history. Okay, fund overview. Okay, the ticker symbol is SDTY, and fund was launched February 2025. Primary exchange is the Nasdaq, and the gross expense ratio is 1.01. We'll go back to XDTE later on to check how much they charge. And the net assets is about 13-14 million. It's a very new fund as of now, so the net assets is pretty low, but that should not affect the performance as such. Like as the fund gets popular and more investors come in, it's going to gather more assets, and at that time, it would become more popular, and the expenses will also get rationalized based on the economies of scale of the fund. Um, Shares outstanding is 300,000, and this could change in the future. Price is about $45. Yeah, I mean the fund is pretty new, and for a new fund, this is pretty decent. And what do they hold? They hold the S&P call options. So these are options which are expiring December 19, 2025, and 1000.26 call, and that's about 88.49%. And they have US Treasury cash. Most of these are cash or bonds or treasury or liquid assets they invest in for the short term to gain a little bit of interest income. But that's not going to be the main focus of the fund. It's a little bit of extra funds that are put into the liquid instruments for earning interest, plus also keeping funds for liquidity requirements. For example, later on when the fund needs more cash for future purchases or redemptions of the fund by the unit holders, or when there is more fund requirement for expanding the strategy or increasing the holdings, or for example taking higher leverage or paying interest costs or operational costs, etc., etc. So the different reasons why they may have extra funds, and but that is very small percentage. Like it will be hardly like 5, 6, or 10% max. Yeah, so that's about the basic features of the fund. Let me quickly compare this with the XTT. First one I want to check is the expense ratio. So the fund, the XDTE was started a long time ago. Like it's about 1 year now, more than a year. This fund is new, so it's not an apple to apple comparison, but still, gross expense ratio 1.01 for SDTY, the YieldMax fund. Let's look at the Roundhill fund, XDTE, is the fees. Let me go to the overview. Okay, that's about 0.97 gross expense ratio. So not much of a difference, just 4 basis points. Like so, SDTY is charging about 1.01. XDT is slightly lesser, 0.97. Not much of a difference, slight difference. And both are active funds. I don't see a difference there. The launch dates are different. The XDT was launched back in March 2024, so it has more than a year of history. So it has more of a track record, plus also some operational experience in the market. SDTY is fairly new. Still, YieldMax is known for these kind of funds, so they will definitely do well, which is what I hope. Both funds are identical in terms of strategy. The way they write the options is also more or less identical. So I don't see much of a difference. Now let's look at the performance, like how these funds have performed in terms of the distributions. Even the price of the funds are more or less similar. See, this one is also in the $44 range. So you can easily compare the distributions also. So the latest distribution I have for XDT is okay, August 29, which is coming up 0.21, like 21 cents. 21 cents here for XDT. Let me look at this one, SDTY, which is the main fund we are looking at. Okay, how do I go to the distribution? Yeah, here it is. Okay, I think they have not mentioned the current distribution, but as of August 8th, sorry, August 15th payable date, it was around 20 cents. So it's more or less in the same range. This one is 21 cents, that is 20 cents. I don't see much of a difference. It's more or less in that range. XDTE is a bit higher. So when I compare the yield, probably it will be slightly different. Like here it says 25. Again, these numbers are not reliable because it's just a, you know, rough calculation by the fund. So we need to check the T12. But let's take this for now as an example. And when I look at number quoted here, yeah, it's about 23.32. It's more or less comparable. So both funds have similar kind of distribution yield. But when you look at the performance of the price wise, it could be a little different. But to do that quickly, I just did a good comparison on the dividend channel website. So I'm going to show you that part. I compared these two funds, SDTY with XDTE. So you have these two. Not sure you can see this on your screen. I'm just expanding it for your reference so that you can see clearly. Okay, I think that looks better. Just trying to bring everything on the screen in one view. Okay. So on the top we have growth of $10,000 with dividend reinvested. On the bottom we have the same growth of $10,000 without dividend reinvestment. Okay, let's assume without dividend reinvested. The bottom you have this SDTY and XDTE, the headings on the table. We are comparing from February 2025 just to make an apple to apple comparison because SDTY was launched recently, February 2025. So we can start from that date to now, to August 26. Starting price is somewhat similar, like 50.29 for this one and 50.39 for the Roundhill fund. And when you look at the ending price, like SDTY has been able to retain, the NAV pretty well. You look at this 45.21, whereas here it is 43.99. Both of them started almost at the same level. So that it tells me one thing, that SDTY is able to retain the NAV much better. Like they have, uh, this is actually few months performance. Like this is not a conclusive evidence or anything. Like this is just my observation. Based on the last 6 months, we can see that SDTY, the YieldMax fund, is able to retain the NAV much better than the XDTE so far. So if you are looking more at principal protection or NAV stability, yeah, SDTY seems to be slightly better, but XDTE is also good enough. I won't say it's that bad as such. When you look at the total returns, SDTY wins here. It's about 1.68 and 1.27 for the Roundhill fund. So this is without dividend reinvested. So even if you just invest an X amount of money in one shot, let's say you invest $10,000 or $20,000 in one shot, and look at the comparison of the performance. I mean, in the past, like so, SDTY has done well in terms of the capital protection. However, when you look at the dividend collected per share, in that case, XDTE wins because they have collected about $7 dividend, whereas SDTY was able to come close to 5.92, close to $6. So that's where you see the difference. So overall, when you look at the comparison of the total returns, in terms of the total returns, you see that SDTY is actually having an edge. It has 1.68 total return, whereas XDT is 1.27. So roughly, I would say it's about 41 basis points, 0.41, roughly 0.4% difference between the two in terms of the total returns. So that's without dividend reinvested. When you look at the top, like with dividend reinvested, they're starting with the same price. The price performance is similar. Like SDTY obviously wins in the price performance. Now, when you look at the dividend part of the equation again, um, we see a similar thing in the dividend. Like you see a similar thing, but when you look at the total returns, the difference is narrowing down a little bit. SDTY is 2.79 and XDTE is 2.40. But even in that case, like the YieldMax fund wins. So, I mean, based on what I observed so far, the 6 months performance, it seems that SDTY has a slight edge, or it is beating, Roundhill fund in terms of the total returns. But obviously, they are paying a slightly lower dividend. So it could be possible that the lower amount of dividend or the way they are distributing a dividend, or there's something which is giving them a slightly better edge. Even the expense ratio is slightly higher for YieldMax fund. So, I mean, it makes one wonder like how they are able to do this. So far, what I see is the distribution wise, they are actually more conservative. So that could have boosted the returns. That's one aspect of it. The second would be an opposite argument. I can take an opposite side of the argument. Like one here, I am trying to say that why YieldMax fund is better. I can take the opposite argument and say that XDTE could be better, or any fund could be better. And in the last 6 months, the market has been too volatile, and that could have favored SDTY. And the market went up in July, August. So overall, this could have benefited the newer fund, and the recent performance would have put it on a higher pedestal. So that could be a reason. So only time will tell how the performance will be in the future. So far, it seems that SDTY is holding up well, and at least the good news is that it's still matching the performances with the Roundhill Fund, and that also brings us with the additional choice in terms of the funds that we can choose. Like earlier, it was only Roundhill funds that people had to pick. Either you pick the XDTE or QDTE or RDTE. Now you have the same, three different indices in the zero DTE, what called format from YieldMax. You can choose one of those funds. And I think there are a few more funds in the US as well as in Canada which are coming up with a similar kind of products. So that is the great news for all income investors. And with that note, I would just like to say that this is not an investment recommendation. So before you even look into SDTY, do your own analysis or research and keep a close eye and watch the performance, and then you can decide whether you want to, invest in it or not. And hope you like the video. If you have any questions or comments, please drop them below. And if you liked what you're watching, feel free to subscribe to the channel and share it with your friends and family. Thanks a lot. Have a great day. Happy investing.